Hey everybody, welcome back to the channel. Today we're going to do an interview with Kurt, the COO excuse me, of Benchmark Protocol. If you haven't heard about Benchmark Protocol, you're not alone. There's not a lot of stuff out there, but a friend of mine told me about it and I checked it out. I thought it was very interesting, and rather than do just a review, kind of wanted to hear it from the horse's mouth and get some real information on it. It's very, very new. As far as like releasing now, and there's some interesting technologies that I wanted to go over with you. How you doing, Kurt?
Hey, Sean. Thanks for having me. I'm doing well. How are you?
I am doing pretty good. If you can, tell us a little about you and how you got into blockchain and what you're doing with Benchmark.
Sure. So I am the COO of Benchmark Protocol. My background is really in traditional finance. I work for a large global financial advisory firm, and got involved in this project really in mid to late November. I have been in the blockchain industry and been investing personally in the space just for, I'd say, about 3 to 4 years now. I kind of hit the 2017 run up, and that kind of was my first experience. But since then, I've been hooked and have been trying to find a way to get involved with the project ever since. And I kind of joined the community of Benchmark Protocol, connected pretty quickly with the team here, and realized that it was a good fit for me to come on board and kind of help get the project launched. So we launched in late November. We had a fair launch process there, and I can talk a little bit more about that here.
I was going to say, if you want to go over what a fair launch is, because it's a little different.
Yeah, sure. So essentially, what we had set up was a platform where users could stake liquidity tokens from Uniswap into our protocol and earn rewards in Mark. And that was not limited to having Mark denominated tokens. For example, users could stake their Chainlink ETH Uniswap LP tokens and earn Mark rewards. And this was super important for us because, couple reasons. First off, we wanted to not have an ICO or an IEO. We wanted to keep that exposure minimal for our community, to make sure that we ensured the long-term viability of our project. But also, and as I'm sure you've seen and everybody has seen, there's been a lot of issues, especially with US-based projects, Ripple and XRP being obviously the main one, that relate to violations of security, or alleged violations of security laws. So we wanted to make sure we did something that was fair to our community, and also from a risk management perspective was important for our project and our team. So we ended up distributing about 6.8 million Mark tokens during that fair launch, represented about 9% of our total supply at the time, and that was really how we kind of put ourselves out there in the market.
I want to read the first part of your white paper, which can be intimidating. The Benchmark Protocol is an uncorrelated liquid and VIX-denominated collateral utility. It is rules-based and the supply elastic that adjusts supply based on volatility indexes, the VIX, and deviations from the target metric, which is equal to 1 SDR, or special drawing unit. That to most people is, gobbledygook. So I wanted to hit on a lot of those things and what they are. I think it's very interesting that you're pegging it not to a fiat currency or a single asset, but to the SDR. The easiest way I could put what an SDR is, it's kind of like the stable coin for fiat. If fiat had a stable coin, it would kind of be an SDR, the SDR. It's like a basket that there's a bunch of different fiat currencies in, so that no one currency is really volatile or it's the most stable, I guess, of fiats. So that's very cool. But a question I had for you is that, from what I understood, do you trade with the IMF for the SDRs, or is it just like linked to it or based? Because I didn't think that. I thought very select like institutions could utilize that.
Yeah, so happy to discuss that. So, I mean, the way we view our protocol is, we're a DeFi protocol that connects traditional financial markets to DeFi markets. We're an ERC20 utility token, and we were initially invented by our inventor David, who is a VP at Citibank. So him and I both have traditional financial backgrounds, and we essentially, the way our token works is we peg to one SDR. The value of one SDR is $1.40 denominated in US dollars. It's an international reserve asset. So what that means is really it's a basket of 5 currencies. It's the US dollar, the euro, the UK pound, the Japanese yen, and the Chinese yuan. And we felt it was important to introduce a collateral or a peg that had diversified currency risk. One of the important things that's a kind of a common element of other rebase tokens or other stable coins, for example, is that they're generally single currency based. And we view that as a risk, and we hope to minimize that risk by pegging to 5 large currencies, or the 5 largest currencies, and reduce that single currency risk as much as we can. And we also think that gives us more appeal in the global market versus a single currency which may have limited utility outside of that particular market. Obviously, the US dollar is pretty strong worldwide. That's not to say that the dollar is strong in general. I'm just saying that it's well known worldwide, and a lot of financial instruments are demised in the dollar. But we really feel that there's a need for something that fills that gap and provides a more global peg in the cryptocurrency space. And so that's why we chose the SDR as our peg. Mm-hmm. And I can get into the way our rebase works around that peg if you want, but that's really why we chose the SDR there. We don't utilize the SDR in any way other than pulling in the price through an oracle. And so we pull in that price. It's actually the Q3 2020 quarter close price of the SDR that we tie to. And the reason for that is to protect against inflation, or at least hedge against inflation. You want to peg to a historical number and then apply inflation gradually over time, rather than just continue to peg to the current price. And that's also another distinction versus a stable coin or other protocols, is that if you just continually peg to one US dollar, you aren't factoring in inflation or protecting against inflation. So our protocol does factor that in, and in our mind,
that's one of the main differences between. Because I want you to kind of hit on: is it a stable coin? Is it a hedge coin? Is it something new? What exactly do you think Mark is, in your own words?
Yeah, it's definitely not a stable coin, because we're traded and we are subject to supply and demand, and the supply and demand will dictate ultimately where our market cap ends up. So we're definitely not a stable coin. I think there's a lot of different terms that get thrown around in terms of, is it an algorithmic stable coin? Is it a rebase token? I think the way we view our project and our token specifically is that it's a supply elastic currency. So our supply will continually change to target a specific price, but never will our token exactly be priced at that specific price for an extended period of time. And it's intended to be that way because we want to make sure we're dynamic, and when you have a supply adjustment token, the way you grow your market cap is when your market price is above your peg for an extended period of time. And that's We're not quite there yet, as we're a relatively new project, but that's how you end up growing market cap and ultimately growing the protocol to a level where it's functioning as intended.
Now you mentioned that the elasticity of the supply.
Yep.
Can you go over the non-dilutive network share? Because that can get a little confusing, I think, for people.
Yeah, and this is a really important thing to touch on right now. Well, while our market cap is so low, I think right now, according to CoinMarketCap, it's 800,000, which is close. We also have a dashboard on our website that tracks our market cap as well. It took us some time to integrate both with CoinMarketCap and with CoinGecko because of our rebase functionality. They don't automatically populate that, so we've had to go back and forth with them quite a few times to get that right, but I think we're there now. So what non-dilutive share means is that when you buy tokens in a supply elastic currency, such as the MARK token, what you're buying is a share in the market. So you're buying a share of the market cap. As the supply is adjusting either upwards or downwards, your tokens are adjusting upwards or downwards in your wallet in direct proportion to your ownership share in that network. So essentially, as tokens are added,
that is where it can get confusing.
Yeah, as tokens are added, your tokens increase, right? So you're never gonna, there's never gonna be a situation where tokens are added or supply is added and your share that you own will be worth less relative to what it was when you initially bought in. And this is important because I think when people who are new to supply elastic tokens buy in, they question, okay, well, why am I losing tokens? What does that mean? And what it really means is when we adjust our supply, we're adjusting total supply. So we're adjusting supply across all wallets, across all smart contracts. That in turn reduces everybody's share equally. So your share will always be constant in the bigger pie. So I'm not sure if that kind of helps.
Yeah, it's more like a percentage.
Yep.
Ownage. That's not a word. It is a word. I don't know. It's a video game word. Ownage.
Yeah.
But so if you have 10% of the circulating supply, then the supply is increased by 10%. Your bag will increase by 10%.
So you should always look at total supply, as the total supply is what's going to be adjusted. When you look at circulating supply, that is essentially total supply less any wallets that are locked. So any foundation tokens, team tokens, stuff like that that's not in the circulating supply. Mm-hmm. Those are adjusted as well. So your share is always going to be in the total network. So I think our supply right now is, if we look at CoinMarketCap here, circulating supply is about 2.9 million mark, and total supply is about 21.4. So we started at 75 million mark, and we've had some negative rebases because we're new and we're trying to gain market share here. But eventually, we're going to reach a stabilized equilibrium level where our price will hit $1.40, and then we'll be trading, essentially at an equilibrium level and subject to supply and demand to see where we go from there.
Okay. I lost my train of thought. Okay. Right. What kind of partnerships or integrations with other projects have y'all come up with, or anything interesting in the roadmap or in the pipeline?
Yeah, so I think I can talk a little bit about the actual products we have available, but also some partnerships. So to address your question, I think we've announced to date 4 really material partnerships, and those are with Solana, Ren Alliance, Elastos, and BZX. And I think with Solana, the purpose is interoperability, right? Right now we're an Ethereum token, but we see the need, as do many other projects, to integrate with multiple blockchains and be able to function across blockchains. And so that's what we're working on with Solana. That's something that we're expecting here Q2 of this year, to kind of roll out the actual integration into the ecosystem. But right now it's been announced and we're working through it, but that's still a future roadmap item to actually implement and integrate. Similar story with Elastos. We're looking to work with them to integrate supply elastic tokens into their ecosystem. With BZX, Tom Bean, who's the co-founder of BZX, has been a huge resource for Benchmark and as an advisor to us. So we have open lines of communication there. And we're less than 2 months old right now, so we're still working to roll out new partnerships and products within our ecosystem. And one other thing to add, we're fully audited by CertiK, so we have that. I guess that's kind of like a partnership, but really it's more of a certificate to just show our users that we've gone through that process. But I think it's important to talk about kind of what's going on with our project as well. So I don't know if you wanted to touch base on kind of the staking mechanisms we have. And
yeah, I did want to ask about the press. I wanted to ask about that and what else what other utilities or what else can people do with the tokens?
Yeah, so we have two main uses for the tokens currently within our ecosystem. The first use for that is really the press, and the press is liquidity mining rewards. So basically, any users that have Mark ETH or Mark USDC liquidity being provided on Uniswap can stake those tokens into our protocol and earn yield on that. Currently, the yield is in the 60 to 100% range, just depending on which pair you're staking. We also have a single asset staking model, which we rolled out earlier this week, and it's been very successful and was received well by the community. And currently it's a 30 to 40% APY in that. And, that gives an option to individuals that don't want the risk associated with impermanent loss for staking LP tokens. So that's, single asset staking. You only have to have Mark tokens. But one of the unique aspects of that is that we're utilizing a dual token model there. So users that stake there in the single asset staking model will receive X Mark tokens. We call this section of our staking model the standard, but the ticker is X Mark. And what these tokens do is these tokens represent a share in the network that has been staked, but these tokens themselves will not be subject to the underlying token rebases. And what that really does for us is give us an on-ramp to other projects or other protocols that currently don't support rebase tokenomics. So, there's certain projects, just as an example, right? Binance as an exchange doesn't have rebase tokens on it or supply adjusted tokens on it. So, this is a creative solution to solve that issue that kind of faces supply elastic tokens. Secondly, with this XMark token, we're going to use it as an introduction to governance. We didn't really have any governance system built out fully. We had plans for it, but we hadn't rolled it out until we rolled out this token. So right now we're in process of moving towards a more decentralized model. But the first step to that, is having a voting system that is weighted based on holders and wallet balances. And so we're doing that through Snapshot and the XMark token. And actually today we rolled out one of our first important proposals to the community, which is kind kind of discussing the length of the smoothing mechanism within our rebase. So right now we utilize a 10-day smoothing within our rebase, and we've seen a proposal go up there now for a reduction of that 10-day smoothing to 3 days. And so current users are currently able to vote on that right now, and we'll see how that vote goes. And you know, that's something that we think is very important, obviously, to make sure that we're on a path towards that decentralization.
Yeah, that was be my next question. But the end goal is total decentralization. What is your strategy as far as like long term is getting people in, and what do you think? What do you think the use case will be for Benchmark in the long run?
Yeah, so I think, you know, initially,
I know, but yeah,
right. You know, I think given how small we are, you know, there's some milestones that needed to happen before significant marketing could occur. The first of those milestones was actually performing our first rebase, which has happened and happened at the end of December. So we've been rebasing about 20 days now. And we don't rebase every day. We only rebase on market days. And actually, I want to circle back to this in a minute. But, you know, to answer your question, it's really co-marketing with our partners to start, you know, trying to get featured in some publications and having organic community engagement. You know, it's important to have sustainable growth. You don't want to do what happens to so many projects, which is unsustainable growth initially really quickly and then a return back to, you know, the level they were at before that. So we're trying to make sure we do things the right way. You know, I've touched on some of our partnerships, so we're working on some co-marketing strategies with them. You know, we're also in the process of driving some more social media awareness very soon. And you know, thank you, Sean, for allowing us to come on your platform here to talk about our project. This is going to be a big, you know, initiative for us, is to get the message out there here in Q1 of 2021. And you know, everyone should follow our socials to kind of keep up with you know, what we're doing. And then the second part of your question was really use cases. So, you know, I think immediately the use cases are what I just described in the press and the standard, which is generating yield. So that is an immediate use case. Another immediate use case that we see is just as traditional collateral within the DeFi lending protocols that exist. You know, right now that's generally been accessible via Ether or stable coins. But we think that there's a market for that with supply elastic coins as well. So we think that Mark is a stable coin alternative in that regard, and could potentially be a better store of value in DeFi ecosystems, given the fact that there's elastic supply and there's not a collateralization model that could lead to issues. But amid, you know, as we continue to grow really and achieve price stabilization, you know, we think becoming a trading pair on exchanges is a viable use case. So, you know, typically, again, trading pairs are denominated in Bitcoin or Ethereum or stable coins, but we think that there's a market there for trading pairs with supply elastic currencies. And then, you know, another midterm use case is really portfolio and asset management. You know, as crypto and Bitcoin continue to gain, you know, market share in traditional hedge funds or asset management platforms, there's going to be a need that arises for non-correlated tokens. And I think a big issue is that everything is really correlated to Bitcoin right now. As Bitcoin moves, so do the other tokens. Or as Bitcoin doesn't move, so do other altcoins. And I think that our project aims to have a unique volatility structure. You know, we're trying to decouple from Bitcoin and other crypto markets by incorporating these traditional capital markets into our rebase. And I haven't touched on this yet, but this is super important, is that we have a unique volatility profile, which is useful for hedging and portfolio management. And that's achieved simply by holding the token. And to get into a little more detail on that, in our rebase model, we incorporate the VIX into our rebase. So the VIX is the volatility index on the CBOE, and it's a real-time market index, or excuse me, on the S&P 500. It's issued by the CBOE, but it's a real-time market index that represents the market's expectations of the 30-day forward-looking volatility. And it's a measure of market risk and investor sentiments. And it's also known as the fear index or fear gauge. And what this does is it gives us a predictive element in our model to our supply adjustments that doesn't exist within other protocols. So it allows us to be predictive about these adjustments rather than just reactionary. So we really have a twofold adjustment there. When our price is below the SDR or above the SDR, we adjust. And then we refine that adjustment by the indication provided by the VIX, which says there's a lot of volatility coming, we need to increase supply. Or there's low volatility, we don't need to increase supply, we may need to contract supply. So there's a dual element there, and that's super unique to our project, and no other supply adjusting token.
I think it's important too with the evolution of the cryptosphere, with so much institutional money coming in, and so many new big players coming in that are from that side of the tracks. You know what I mean? Those are the things that they're looking at. That is what they're using. So a lot of those, I mean, you can call them self-fulfilling prophecies, but that's what they're looking at. So I think that's something that that everyone needs to kind of look at from now on, as we grow to eventually eventually crypto is going to be just, I think, the same as, every other market. It's just going to be looked at as one of the markets, whereas now it's this new little niche thing. I think it's going to be and I don't think it's going to be that long. So I really did like how you guys were doing that.
Yeah, I agree with that, and I think that's why it's important to have an asset that's not correlated with the broader market. I mean, in any market, right, you have to be able to hedge, and you have to be able to have tools at your disposal to manage a portfolio properly, right? I mean, it's great when we're in the market we're in now, where you can just see everything going up, but it's not always like that, and that's what was seen in March, right? When kind of all markets crashed, right? Equity markets crashed, Bitcoin crashed, altcoins crashed. There wasn't really anything in place that somebody could park their money in that made sense. And this is a really actually important topic as well, is, why are we different than a stable coin, right? Because at the time, the thought is, oh, well, when in a down market, I can just park all my holdings in stable coins and be fine. But there's a couple issues with that, and one is that stable coins are primarily tied to a single currency, so they have the single currency risk and inflationary risk, and we've talked about that, and how we adjust for that, and by pegging to the SDR. But additionally, and stable coins are issued in different ways, but using an example, a common model for issuing stable coins is to take collateral and then issue a stable coin in return for that collateral. But if that collateral plummets in value, the stable coins themselves have no backing. And if users wish to then go return their stable coins in exchange for collateral, that collateral is going to run out. And this is similar to the concept of a run on a bank, right? Where if everybody went to liquidate their savings accounts at a bank, the bank wouldn't have enough dollars to pay out. And so this is the perfect example of why it's important to have a supply elastic collateral rather than a fixed supply collateral or a stable coin that's based on underlying collateral. When you have elastic supply, you can always meet that demand. And so that's where we see a huge need for our token and other supply elastic tokens in the DeFi space.
All right, Kurt. Well, I appreciate you coming on. That's all I had to go over with you or ask you. I think you cleared up everything I wanted to know about. Anything else you wanted to go over?
No, I mean, I think that's pretty much it, Sean. I mean, certainly wanted to thank you for your time here, and you know, it's always great to get to come and talk about our project, and would encourage any of your viewers, if they want to learn more, to join our Telegram group, visit our webpage, and ask any questions they may have. The team is always active in our Telegram. I'm always active, happy to answer questions. So it's really a direct link between our management team and the community. We're all there, and we're all willing to help. And as you noted, this is a unique project, and something that's not intuitive to people with trading experience. You know, people are generally used to seeing supply and demand reflected in price, not supply and demand reflected in number of tokens they hold. So it's certainly unique, and would love the opportunity to answer any questions that anybody has in our Telegram group or our Discord channel. And again, just wanted to thank you for your time.
I appreciate it. Appreciate you coming on. I'm going to have links in the description so you can go over to Benchmark, check them out, check out their Telegram, join the community, learn a little bit more. You take care, Kurt. Thanks for joining me, everybody. You take care. I'll see you on the next video.